Have you ever looked at the stock market, seen a big red arrow pointing down, and immediately thought, I should wait until it goes back up before I invest? Then, a few months later, you see it skyrocketed and you feel like you missed the boat. Here's the hard truth: that instinct is usually wrong. Trying to time the market, buying at the bottom and selling at the top, is like trying to catch a falling knife. It sounds exciting in movies, but in real life, it's a recipe for stress and lost money. Welcome back to Fiscal Beacon. I'm your host, and today we're talking about the single best tool for the lazy investor. Now, don't let the word lazy fool you. This isn't about being inactive. It's about being smart enough to realize that you don't need to be a genius to build wealth. You just need a system. That system is called dollar cost averaging, or DCA. In the next 10 minutes, we're going to break down exactly what it is, show you the math with real numbers, and explain why it's the secret weapon that allows everyday people to beat professional traders. So, what is dollar cost averaging? Let's strip away the finance jargon. DCA is a strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. That's it. If you decide to invest $500 every month, you invest $500 in January, $500 in February, $500 in March, and so on. Here is the magic part. When prices are high, your $500 buys fewer shares. When prices are low, that same $500 buys more shares. Over time, this naturally lowers your average cost per share. You aren't trying to guess if the market is high or low. You are simply participating in the market consistently. Think of it like buying groceries. You don't wait for the price of milk to hit rock bottom before buying it. You buy it when you need it. DCA treats investing the same way. It's consistent, predictable, and boring. And in investing, boring is good. Let's look at the math, because numbers don't lie. Imagine two scenarios over a 1-year period. Let's say you want to invest $1,000 total. Scenario A is lump sum timing. You try to time the market. You put all $1,000 in on January 1st when the price per share is $10. You buy 100 shares. Then, the market crashes. By June, the price drops to $5. Your investment is now worth $500. You panic and sell, locking in a loss. Now, scenario B, dollar cost averaging. You invest $100 every month for 10 months. Month 1, price is $10. You buy 10 shares. Month 2, price is $9. You buy 11.11 shares. Month 3, price is $8. You buy 12.5 shares. Month 4, price is $7. You buy 14.28 shares. Month 5, price is $6. You buy 16.66 shares. Month 6, price is $5. You buy 20 shares. This is the crash, but look, you're buying more shares now. Month 7, price is $6. You buy 16.66 shares. Month 8, price is $7. You buy 14.28 shares. Month 9, price is $8. You buy 12.5 shares. Month 10, price is $9. You buy 11.11 shares. At the end of the year, the price is back at $9. In scenario A, you had 100 shares worth $900. You lost $100. In scenario B, you bought a total of 138.2 shares. At $9 per share, your portfolio is worth $1,243.80. You made a profit, even though the market dipped significantly in the middle. Why? Because you bought more shares when they were cheap. That is the power of DCA. But here is the real secret weapon. It's not just the math, it's the psychology. The biggest enemy of your wealth isn't the market, it's your own emotions. When the market is soaring, you feel FOMO, fear of missing out. You buy at the top because everyone on social media is talking about how rich they got. When the market crashes, you feel fear. You sell at the bottom because you're scared of losing more. Dollar cost averaging removes the need for decision-making. You set it up once and you automate it. On the 1st of every month, money moves from your checking account to your investment account. You don't look at the news. You don't check the charts. You don't ask, is today a good day to buy? The answer is always yes, because you are building a habit. This is what we call set it and forget it. It allows you to sleep at night. Now I know what some of you are thinking, but what if I wait for a crash and invest a lump sum then? Won't I make more money? Statistically, Yes, investing a lump sum immediately often outperforms DCA over long periods because markets tend to go up over time. However, most people cannot handle the volatility required to stay invested through a crash. If you wait for the perfect entry point, you might end up waiting forever. The market can stay irrational longer than you can stay solvent. DCA isn't about getting the absolute best price. It's about getting started and staying consistent. It's the difference between trying to be perfect and being effective. So, how do you actually start? This is the easy part. You don't need a fancy broker or thousands of dollars. Here is your action plan. Step 1. Choose your vehicle. If you are investing for retirement, look at a Roth IRA or a 401k. If it's for a general goal, a taxable brokerage account works. Stick to low-cost index funds or ETFs, like an S&P 500 fund. These track the overall market, so you don't have to pick individual winners and losers. Step 2. Set the amount. Start with what you can afford without feeling pain. Even $50 a month is enough to start the habit. The key is consistency, not size. You can always increase the amount later when your income grows. Step 3. Automate it. This is non-negotiable. Log into your investment platform and set up a recurring transfer. Make it happen on payday. If you wait until the end of the month to remember to invest, you won't do it. You'll spend it on something else. Make it invisible. Step 4. Ignore the noise. When the news says market crash, do nothing. When the news says record highs, do nothing. Keep buying. Your automated system will handle the work for you. Let's be clear, DCA is not a get-rich-quick scheme. It is a get-wealthy-slow-and-sure plan. It requires patience. You might have months where your account is in the red. That is normal. That is part of the process. But over 5, 10, or 20 years, the compounding effect of consistent investing, combined with the lower average cost basis you've built, tends to smooth out the ride. Remember, the goal of personal finance isn't to be a trading genius. It's to secure your future with minimal stress. Dollar cost averaging gives you that peace of mind. It turns investing from a daily job into a background process. Before we wrap up, a quick disclaimer. I am a content creator, not a financial advisor. This video is for educational purposes only. Every financial situation is different, so please consider consulting a qualified financial advisor before making any major investment decisions. Do your own research and never invest money you can't afford to lose. If you found this breakdown helpful, hit that like button. It really helps the channel. And if you want to master more simple, effective money habits, subscribe and turn on notifications. Next week, we're tackling the 50-30-20 rule, how to budget without feeling poor. You won't want to miss it. Thanks for watching Fiscal Beacon. Keep it simple, stay consistent, and I'll see you in the next